Hello and welcome. Today we're working on the units of production depreciation method. This is also called the activity method, so it's a method in accounting of depreciation. We're going to do two problems in Excel, so let's get started. Hello, my name's Jeff from Finally Learn, where I help you finally learn financial skills like accounting, finance, Excel, so on. So let's talk about depreciation and depreciation expense just for a second before we start our first problem. So in accounting, we're trying to figure out the depreciation expense, so it's a very specific definition. We're trying to allocate the cost of a fixed asset over its useful life. Now, depreciation expense reduces net income, reduces income taxes, so we're happy about that. Now, there's four different methods. I have a playlist that I'll link below on all the different methods. This is the units of production method. I have all the other three videos already complete. Now, in business, you'll hear the term depreciation, which just means a reduction in the fair value of the asset. So they might say, instead of, hey, a stock went down $3, it says, hey, the stock had depreciation of $3. And so it's just a valuation kind of idea. So here's how you remember it in accounting. Accounting is valuation because we're trying to figure out the depreciation expense. Business is the idea of valuation. What's the fair value? Now, just a background of depreciation, it's all about the wear and tear over time of a long-term asset. It has the age on it, or the use, or obsolescence, or so on. So let's get to our first problem. Now, let's assume we purchased this truck here, and we purchased it on January 1, 2021. And the cost was $108,000. The salvage value, what we think it's worth at the very end, is $20,000. And here's the key. Instead of saying we think it's going to last for 5 years, we say something like, hey, we think it's going to last for like 100,000 miles. So we have to have some basis, some units of activity or units of production or whatever. So if we take the cost minus the salvage value, that gives us our depreciable base. So it's going to be 108 minus 20,000. We're going to depreciate over time $88,000 of this asset. So here's our formula. Depreciation expense is going to be the cost minus the salvage value divided by the total units. And the units here are in miles. We could call this total miles if we wanted to. So let's just do the math and we'll start thinking about this problem. 108,000 minus the 20,000. We're going to depreciate over these 5 years or so, or over these 100,000 miles, $88,000. And so our units are in miles, so it's 100,000 miles, just to make it really easy. We're going to take the 88,000 divided by the 100,000 miles, so we're going to expense 88 cents per mile. Now, another feature of the units of production method is we need to know how many miles are driven. So I put this in blue because it's also given information. So all this is given information. So the first year we drove 20,000 miles, and then 24,000 and 29,000 and so on. So we need to set up a little schedule here, so a little depreciation schedule or depreciation table. So I've got it for 5 years because that's the years that we have. We're going to do book value, the beginning book value. And what is book value? Book value is the cost minus the accumulated depreciation. So the original cost minus the accumulated depreciation is book value. We're going to do depreciation expense. That's our goal of what we're trying to do with these problems. And then we'll total that up, and that's called accumulated depreciation. You could call it total depreciation. That's fine. And then we have ending book value. So let's just do it line by line. I'll do the first two or three and then copy down, and we'll make sure that we have our table correct. So our beginning book value is $108,000. That's our original cost. What is our depreciation expense? Well, our depreciation expense is we have driven 20,000 miles in 2021, and we're going to multiply that times the 88 cents. Now, I'm going to make 88 cents absolute, so I'm going to put dollar signs in front of the H and the 9. And so if we take 20,000 times 88 cents, then we have depreciation expense of $17,600. Now remember, we're allocating based on 100,000 miles. So we're allocating that cost over the 100,000 miles equally per mile, 88 cents per mile. So our accumulated depreciation is just going to be that number. And the ending book value is going to be $108,000. We'll make it absolute there, minus the $17,600. All right, so that's our first year. So our first year depreciation is $17,600. If we wanted to make a depreciation expense entry, the adjusting entry, it's going to be depreciation expense of $17,600 and accumulated depreciation on the truck of $17,600. So we do that every year, and every year is going to be a little bit different because we have different miles each year. Okay, so let's do the second year. The second year, our beginning book value is the ending of 2021, so that's $90,400. We're going to take the 24,000 miles times the 88 cents. The 88 cents, make it absolute, because I want to copy that down here in just a minute. And then the accumulated depreciation is going to be the previous year's depreciation plus the current year depreciation. So now we have depreciated $38,720. And so we're going to take the $108,000. I'm going to make it absolute minus the $38,000. So what is our ending book value at the end of year 2? Well, it's $69,280. We're going to continue this all the way down. So let's do one more, then I'll copy it. So our beginning book value is going to be the $69,000, the ending of the previous year. The depreciation expense is going to be 29,000 miles times the 88 cents. Now I'm going to make the 88 cents absolute so I can copy it down, and it'll pick up the 33,000 and the 24,000 respectively on the next one. The accumulated depreciation is going to be the previous 38 plus the current 25. So now it is at 64,000. We're going to have 108 minus the 64,000. So our ending book value is going to be 43,760. Now I'm going to copy these next two down. So we'll copy this down. Depreciation expense. In fact, I can do these more than one at a time. So the depreciation expense is going to be what? It's going to be the 33,000. You see, I picked up 33,000 times the 88 cents. So then we have 93,000 total, and 14,720 is our ending book value. Well, let's do one more year and copy it down, and we'll be finished. But we need to check our work. All right, so if we do this, let's check our work before we decide that we're finished. Let's add up the total. Now watch, the total has to be 88,000. 88,000. And we're going to stop at the salvage value of 20,000. So we need to stop at 88,000 total or 20,000 total. So we need to adjust. So we need to make this, we're going to plug this in. We're going to get rid of this row. We depreciated too much. And here at 43,000, we've depreciated 29,000. And so we've gone above our 88,000. So here's what we need to do. We need to run the math on this one and say 43,000 minus the 20,000. And that's 23,760. Our accumulated depreciation is 88,000 total here. And our book value is 20,000. Now, how do we get to this point? Now, just because we said 100,000 doesn't mean this adds up magically to 100,000. So let's see what we have. We have these first four, if you see down here, that equals 106,000. We're only going to depreciate over the first 100,000. It rolled 106,000 the first 4 years, and then it did another 4,000. So at 5 years, we have 130,000 total miles. So we're going to have to stop at the first 100,000. So this is only about a 4-year asset rather than a 5-year asset. So be careful. You can kind of get lulled into sleep and not pay attention to what's going on. All right, so our depreciation expense entry would be these numbers all 4 years. Okay, let's do another example. And let's say instead of having a truck, let's have a piece of equipment like this piece of equipment, and let's say that the cost is $225,000 and the salvage value is $50,000. And instead of miles, we don't measure the work on equipment like this or machines like this that is in miles, because it doesn't really go very fast, we measure it maybe in hours. So let's say it's purchased on March 1st. Now, a partial year is a big deal in like straight line or double declining balance. Well, we'll show how this is not that significant on the units of production method. So what's our cost? Our cost minus our salvage value, our depreciable base, is going to be $175,000, and we're going to allocate that over the 20,000 hours. Now, one thing we want to watch for, what's our total hours? Our total hours are just going to be slightly above 20,000. So you see way down here the sum is 20,800. So we're going to have to adjust the fifth year. So 175,000 divided by the 20,000, we're going to depreciate not per mile but per hour. So let me change this to per hour. So every hour that the machine runs, we're going to depreciate $8.75. So here's how we do this. This should be familiar to you. We're going to take the $225,000, that's our original book value. Our depreciation expense is going to be $3,800, and this is going to be multiplied times the $875. We'll make that absolute. $33,250. Our accumulated depreciation is going to be that $33,250, and we'll take our original cost of $225, make it absolute, minus the $33,000 next to it. So what we have allocated is depreciation the very first year of $33,250. Now I can copy this one down. Let me just copy this one down each of the years. And so this is going to be, let's look, the math works. This is one reason why we do Excel, because we can see that year 2 we should take the 4,400 times the 875, and that's what happens. So these are the raw numbers. We may have to adjust. Remember, we know we're above the 20,000. So here's how we do the second year. The book value is going to be that previous ending book value. The accumulated depreciation will be 33 plus the current year. And then the ending book value is going to be the original cost, $225,000, make it absolute, minus the $71,000. Now, what is our total depreciation expense? What do we want it to be? Well, it's going to be our depreciable base of $175,000. So let's go ahead and copy this all the way down. Copy it down and copy this. Wait a minute, let me do this one. Copy it down. Copy this down. And let's check our total. Now we know our total is going to be a little high, so we want it to be stop at 175,000. We've got 182,000. We know we cannot go below the 20,000, and so our ending, 50,000 here, the salvage value. So our ending is at 43. So what we need to do, we need to adjust this depreciation expense for the last year, 78,000 minus the 50,000. And so that's going to be exactly 28,875. And we have total depreciation of 175,000, and our ending book value is 50,000. All right, so our first year depreciation is going to be depreciation expense and then accumulated depreciation for the equipment of $33,250. We've calculated depreciation each year. All right, thanks for watching.